Our next guests are announcing a new fund to help address the affordable housing crisis in the United States. Joining us right now is John Hope Bryant, who is the CEO of Bryant Group Ventures and founder, CEO, and chairman of Operation Hope. Also, Joseph Otting, who is Flagstar Bank president, CEO, and executive chairman. And gentlemen, welcome. Thank you for coming in this morning. Let's talk about the point of this new fund. Obviously, housing has become less and less affordable. So what's the point of this fund? What's the goal in terms of what it's hoping to accomplish?
So the fund is a first of many. This is part of an impact partnership with CIM. So it's a CIM and Bryant Group Venture Impact Ventures. This fund puts an anchor down in affordable housing for multifamily, which, as you know, is a huge crisis in the country. There's something like 4 to 7 million units that are underwater that are needed in this country. But the magic sauce here is the capital stack. So to go to the bank, Community Reinvestment Act, which has been used episodically. A church sponsors something here, a corporation or a mayor sponsors something here. No, there's no scale. There's no rinse and repeat. You can't scale that. But that capital, if you use it properly, is below market for equity and below market for debt. So what we decided to do was to combine doing well and doing good at the same time. And my vision, my experience, it leaned into capitalism with an institutional partner like CIM, which is $30 billion, and tap banks for equity and debt. So for every dollar of equity, you get $2 of CRA debt that you can access below market. That makes the numbers work. There's two ways of making money. You make more, you spend less. People can't afford to spend more. So we're able to provide financial literacy, make sure that 30% of the contracts on approximately for maintenance go back to the local community, plumbing, heating, electrical, landscaping, roofing, et cetera, so that reinvest in the community. So it's streets to suite strategy. So you're still hitting your marks, you're still hitting your numbers, the banks are breaking safe and sound loans, you're still market economy, but because of you're accessing this below market, slightly below market equity and debt, it all works. And you can scale that up. And I'm told, Becky, that this is 10 times larger, unfortunately, than the next largest effort in this space. And I think that's because it was just localized. So this is going to be national. So
you have $250 million that you've already raised, right, and that's 10 times greater?
Unfortunately, yeah. It seems, for Wall Street, these are not big numbers. But for Main Street, this is a game changer. And if you can partner now with mayors who see capitalism typically as not as their friend, you can partner with municipalities, with organizations. Somebody has a title to a property. They have the zoning. They've got the plans. They don't have the capital. They don't have the equity. They can't qualify for the debt. We can come in and possibly partner with them, maybe buy that property and give them some development experience. And we take on the institutional responsibilities. So it's really a first ever in the structure. It's not, of course, the first fund.
The structure question I have is the distinction between the cost of this equity and debt is how much lower than market price, if you will.
Well, I think you have to look at it this way, Andrew, is banks have an overabundance amount of money they want to flow into CRA. I'm not aware of any bank that says I have too much CRA qualified investments or debt. And so what this gives them the ability to do is have an efficient way to funnel those proceeds into projects in communities across America where they have a need for CRA investments. And so banks don't necessarily look at it for a market rate return and are willing to accept below market rate returns to do what I would consider good across America.
I guess that's what I'm asking, though. The below market rate return is what relative to what you think the market rate return is?
Probably 70 to 75% of a normal market rate return, because it's more about fulfilling the needs of CRA than it is getting a return on the investment.
So it's mission-centered money. And because there's more to it than just raw return on the capital, they're willing to, and it's a longer-term capital. So we're talking about a 10-year commitment to a naturally occurring affordable housing. So there's about $500 billion a year that gets committed to Community Reinvestment Act, which is a big number. And but it's never been institutionalized in the way in which we're trying to do.
Does all that money typically already get spent, though?
Not all of it. There's different vehicles that can be used for that. It can be where a bank will make a mortgage and they do it in a low to moderate income area and they can get qualification for CRA. But banks have an enormous appetite for making these kind of investments across America.
So the fund helps unlock the CRA?
Well, what it does is it creates an efficient vehicle that banks can go to. In a CIM fund today, a bank may say, I have real needs in Los Angeles, or I have real needs in Boston, or I have real needs in New York. The fund's intent is to be able to do projects in those communities, and then banks can look at that portfolio and say, I want to make investments here, or I want to make investments there. And so today, we have to basically go out and discover those projects one by one, which is very difficult to do. This creates a very efficient vehicle for banks and investors to be able to identify projects via CIM to be able to do that.
Joseph, we talk all the time about how it's kind of a tale of two economies right now. The people at the top are doing very well. The people at the bottom are not. What do you see in your banking at this point?
I think that's an accurate assessment. Where you see the stress in the economy today is really the people that are the working class parts of America. High inflation, high energy prices impact them directly. And whatever we can do to lower housing costs or energy costs or interest rates, $100 or $200 makes a big difference in those households.
50-year mortgages, that's been the huge debate kicked off in Washington over the last several weeks. There are people who say, yeah, it's a way for someone to be able to afford a home. There's others who say, wait a second, this is basically indentured servitude. You're going to be paying it off for the rest of your life. What do you two think about it?
I think it fits, your individual, cash flow situation. Personally, I think it's a great idea for certain people to have that as an option. Today we do interest-only mortgages. So if you think about it, at least it's some amortization. The other thing is the average mortgage, probably a little longer today because of the last cycle, how low interest rates got. But the average mortgage is only about 7 years to begin with. So it isn't like people generally sit in their homes for 30 or 40 years. They trade up. And so this, I think, gives people the ability to be more affordable, make more housing within reach for certain segments of the population.
So the 30-year mortgage, Becky, was created at a time where people lived to about 60. Mm-hmm. And so I think if you look at it from a 50-year period, it doesn't make sense if people are expected to live to 100. But if you can get a release, if it's an assumable mortgage, if you can release yourself from it from 7 to 8 to 10 years, and it's an affordability issue, if that is how it's structured, then again, the structure is really important. It might make some sense, but it doesn't.
The average age for buying a home now is like 40 years old.
Right.
For a first-time buyer.
Right.
I mean, so you're 90. You're not working until you're 90.
There's probably better ways to structure a solution. It's nice that people are looking at alternatives. I like that. Anything that can bring affordability down, that's a conversation I want to have. As you know, a lot of it's in the how. A lot of everything is in the how, not the what. And so good intentions are well, and I commend that. And I commend Washington for putting a foot forward for affordability. I think there's a more elegant way to get to the same objective. I don't know in its present form if that sort of works. But like this, I mean, this is not rocket science, but no one has done this with CRA bank funding before. And so maybe you can take pieces of this and marry it with something like, for this example, we have mayors now who are saying, we're going to give you, if you can come to our city, we'll give you tax abatement. Well, that's not available to a traditional commercial developer or fund. We got some land. Because of your reputation, because your mission, it's for a decade for affordability. You're not going to flip the property on somebody. We'll contribute land to this. Well, all of that reduces the cost of the development and ultimately the cost of the rent to the end user. So this is win-win, and it's scalable. And as you said earlier, it's not at its objective yet, but $250 million, I'm told, is 10 times larger than anything, which is really sad, than anything that's been done like this before.